Your investments and standard of living are being destroyed right now, but what's causing it might surprise you. It doesn't just affect Americans, it's actually even more dangerous for people living outside of the US. The strengthening dollar is decimating global markets. It's causing unimaginable suffering across the globe and has the potential to push the entire world into a deep economic recession all by itself. But why would a strong dollar affect you if you're living in Asia or Europe or wherever you're from? And how could it cause you to pay more for your food, your energy, and even your mortgage? What's worse is that the dollar could actually shake the stability of your entire economy. I'm going to show you how a strong US dollar is a major problem, what's causing it, and if there's a way to fight against it and even profit from it. The crazy thing is that this has all happened before, but back then a secret plan came into the rescue. But will it work a second time? That remains to be seen. But first, what is the root cause of the dollar's apparent strength? The quick answer is fear. There are so many worrying developments in the world right now that people are just looking for somewhere safe to hold their money. As the world's reserve currency, as surprising as it may seem, the dollar is seen as the safest place to be. So investors and governments are queuing up to dump their currencies and load up on the dollar. This has been so extreme that the Dixie, or the dollar value index, is at its highest level since 2002. And the kingpin to the whole situation is, of course, the Federal Reserve. They've taken actions that have crushed markets and destabilized countries across the globe. But why would they do this? Well, because the Fed is in charge of maintaining a healthy economy in the US. And as any American will know, inflation is rampant right now, with food prices, gas, and everyday items skyrocketing. One of the main jobs of the Fed is to keep inflation under control, and its main tool to achieve that is, of course, by raising rates. It's going to crank that dial as much as it needs to, and the last thought on their mind is how it's going to affect another country on the opposite side of the globe. Their responsibility is the US economy, at the peril of everyone else, unfortunately. Rates have been near zero for the best part of 10 years, which of course has resulted in incredible growth and with it inflation. But with the recent spike, the Fed has been forced to raise rates and was the first to do so out of any central bank. Not only that, but they've been consistently raising rates, far outstripping any rises in other economies. This led to a rapid decline in assets and equity valuations across the board, whether it's in US stocks, property values, or even crypto. As the cost to repay interest on debt rises, people and companies reduce their spending, they sell off their holdings, and thus increases the demand for the dollar. If any of you are watching your portfolio tank right now, this is the big reason why. Is the US dollar actually strong though? If you're living in the US, you might be wondering how you could be calling the dollar strong, since inflation is so high. Every time you go to the store, pretty much everything you see on the shelves is more expensive than the last time you went there. But here's the secret. It's not strong. Its strength is just an illusion compared to other currencies. In reality, every currency worldwide has seen massive devaluation over the past few years as countries desperately are trying to print and stimulate themselves out of the crisis. The difference between the global economy and America is that the US economy has fared a lot better than the rest of the world and is more resilient, able to higher handle and faster rate rises to combat inflation than other economies. It's great for the US, but not great for everyone else. And because of this, the US has been accused of exporting their inflation. Some countries are just too unstable right now to handle significant rate rises, which could push their economies over the brink and cause widespread suffering. It's a vicious cycle. If they don't raise their rates, their currency sinks even further, pushing inflation higher. If they do raise rates, they could potentially damage their economy, or even worse, cause a sovereign debt crisis. You might not have heard of a sovereign debt crisis before, but you probably know it as national debt. It's simply government-issued borrowing funded by citizens or foreign nationals. A sovereign debt crisis is the potential for a country to be unable to afford their debt repayments, and this can really cause some economic damage and unrest. The Greek debt crisis was an example of this. If the debt to GDP ratios get too high or interest rates creep in, large debts become more expensive and the risk of repayments becoming unaffordable rises. This is even made worse when the debt is denominated in a foreign currency. Here's where we come to one of the largest issues facing global stability today. With historic interest rates being low for the past decade, many developing nations took out loans issued in dollars. They were cheap and freely available. The US basically handed them out like Halloween candy. However, the nations that took these free candy loans are about to choke on that candy. As the dollar strengthens and the interest rates rise, the debt is becoming more expensive to pay every single day. Imagine you have a friend who lends you some money and wants to get paid back in their own currency. If exchange rates stay the same, of course, no problem. You can make the repayments without any issues. But if tomorrow your currency suddenly drops by 50%, you need to pay twice as much to keep up with the repayments, unless your income is doubled as well. That extra money needs to come from somewhere. Usually that's from your savings or by cutting back on your lifestyle. This is exactly what's happening happening, but on a global scale. A number of major economies right now are struggling with the surging debt and the threat of real financial collapse. In the last month, the Bank of England took its second emergency intervention in the UK bond markets and stated that there's a real risk to UK financial stability. The chaos in the UK bond market was triggered by an unsustainable increase in borrowing to deal with the energy crisis and an economy on the brink of disaster. The UK isn't the only country facing debt problems. Italy, which is of course the third largest economy in the EU, is facing a sovereign debt crisis as well. Rising rates are putting their economy under immense pressure as their 135% GDP debt load forces massive political upheaval and protests. The European Central Bank actually raised rates by 75 basis points this year, the first time in EU's history rates have risen that fast. Sri Lanka has already been a victim of economic collapse this year, and China is currently facing a massive housing crisis. If you want to learn more about that, I've actually made a video on that, which you can see here. Japan is the world's most indebted country at 240% and is in such a precarious position that its central bank is refusing to raise rates with the fear that even a small increase could completely destabilize the economy. These are the underlying risks to individual states and the global economy, but aren't the only factor being pressured by a strong dollar. Something we've all experienced is the rising cost of food and energy. Yes, geopolitical factors are at play here, such as the war in Ukraine and global supply shortages. A large part of this increase is rooted in the dollar's status as the world's reserve currency. Most global trade, especially in the energy and commodity markets, is legally required to be done in dollars. That means that any government or company trying to buy oil must first get hold of US dollars. This requirement means that relative expensive materials, food and energy is intrinsically tied to how expensive the dollar is relative to other currencies. To put it simply, the worse your currency performs against the dollar, the more expensive everything else will be for you. A barrel of oil could stay flat at $100, but if your currency drops 10% against the dollar, that barrel is going to be 10% more expensive for you to buy. Usually, a strong dollar would cause commodity prices to fall as demand falls, but not everything is produced in the US, of course, and a strong dollar makes foreign exports cheaper and increases demand. Imagine you live in a country with a weak currency, or maybe you even do, where your exports are valued in dollars. As your currency devalues, you get more for your currency in exchange for those dollars that you receive. You can see this in action when you're comparing the gold price chart in your currency and in dollars. If you only looked at the dollar chart, you'd assume that gold has been falling in value for the last 2 years, which in dollars it has, but for any other currency, gold has actually been rising in value. This is completely because of exchange rates, but the perception is real. A US trader would have lost money, a European trader would have made money, all by holding gold. But with all that being said, how do you benefit or profit from this? If you're an American, a rising dollar will actually have some benefits for you. While it might not feel like it, inflation should come down slightly, though there's a lot of inflationary factors right now that outweigh any relief that this might give you. One thing that you'll definitely notice is how cheap foreign products might seem. A strong dollar means that you have more power when buying things overseas. As other currencies drop against the US dollar, you can buy more for the same price. This leads to an increase in imports as consumers and companies buy up global products with their valuable currency. If you've had your eye on some exotic overseas products, now would probably be the best time to buy them. Or you could take a vacation and go get those products yourself. Your dollar will go much further when it comes to food, transport, accommodation, everything in other countries. But of course, it's not all good news. US companies relying on exporting their products get hit hard and see demand drop as they get priced out of cheaper global competition. This also impacts companies that make profits overseas. Their business might not be affected in those countries, but they're still required to report their earnings in dollars, which obviously has a disastrous side effect. Even if their sales grew, that growth might not outpace the devaluation of the revenue in the foreign currency, which results in an overall decrease in profits. It sounds weird, but that's one of the nuances of international business. A lot of major US companies have issued profit warnings to their investors already for this exact reason. As overseas profits appear to drop, so does the valuation of those companies. Almost 40% of the S&P 500's revenue come from companies outside of the US. So you can see why the S&P has dumped so much in the last year. Another quirk of foreign exchange markets is when overseas investors have holdings in dollar assets. Even if a $1,000 investment doesn't change in value, the exchange rate does. And some countries have declined as much as 30% against the dollar this year, meaning that those investors have essentially made a profit of 30%, which of course doesn't sound bad, but this can lead to foreign investors taking profits and pushing company and asset valuations even further down. It's a chain reaction similar to when people see fear in the markets and they sell because they have fear themselves, pushing the market down even further. But how long does all of this last? The truth is, I have no idea how long the situation will continue or how much stronger the dollar will get. Actually, nobody does. With more bad news on the horizon and markets fully filled with panic, I don't see the situation getting better anytime soon. Inflation is still stubbornly high in the US, and the Fed has already committed to continue raising rates until it's pushed them back towards 2%. Whether or not you agree with the Fed's policy, it's easy to see why they're doing it. Skyrocketing inflation is something everybody feels every day. Yes, investors might suffer and it might damage foreign nations, but in their eyes, that's a small price to pay to keep the US population from rioting. But can these other nations besides the US do anything about it, or are we at the mercy of the almighty US Fed? Well, back in 1985, there was a similar situation with a strong dollar hammering worldwide economies. The world's leading nations at the time, Germany, France, Japan, and the UK, all met with US representatives to draw up a plan to devalue the dollar. In an echo of today, the strong US dollar was actually hurting exports in the midst of a recession and was pushing the prices of energy and materials for other countries up. It was a mutually beneficial decision for them to fix this problem, and that led to all nations agreeing to currency intervention. Over the next few years, the dollar declined, losing half of its value against other currencies and stabilizing the market. But can the same thing be done today? The same plan should work, right? We're in a similar situation after all. But unfortunately, currency intervention is unlikely, and a global agreement with the world's largest economies would almost be impossible to achieve today. The world has changed significantly in the last 37 years to get everyone to agree and be on the same page. The US, of course, would be unwilling to weaken its own currency because this would push inflation even higher. China, the world's second largest economy, benefits from a trade surplus with the US already, which is growing as the dollar strengthens. A strong dollar is, of course, in their interest too, so they wouldn't help with that either. That's the two largest economies in the world essentially taking the ball home and deciding that they're not going to devalue the US dollar. The other world economies would be forced to take unilateral action if they wanted to prevent their currencies from being crushed. And this is already happening to some extent, but obviously with mixed results. In reality, the world is in a really tough spot right now, and whether you live in the US or somewhere else, this is going to affect you, and there's not much that you can do about it or any one country can do about it. Let's just say that the war in Ukraine resolves itself. This would obviously calm some of the energy and food markets, helping alleviate some of the global inflationary pressures, but with recent events, this looks less and less likely to happen. Another big relief would be if China managed to stop locking down its manufacturing hubs for weeks at a time. This caused immense disruption to global supply chains already. They'd also have to fight off the impending housing crisis. Again, neither of these seem like likely outcomes. As you can see, there's a lot of ifs involved, and a bunch of large crisis points across the globe would have to resolve themselves. As a betting man, I wouldn't put my money on things getting better anytime soon. But what can you do? Is it all hopeless, or can you actually protect yourself or maybe profit from this global uncertainty? I've released several videos recently talking about inflation, pending recession, and things you can do to increase your income and build your wealth during this time. All of this information will help you, but the strong dollar is still an absolute wild card. As simply as I can put it, some countries are really going to struggle over the next few years, and whether your country does or does not will be down to how robust your economy and leadership is. If you think your country is handling the recession badly, then it might be a good idea to diversify yourself in global assets. You run the risk of your country doing particularly poorly and facing a debt crisis, a deep depression, or in Sri Lanka's case, a total economic collapse. In that situation, the best place to hold your wealth is, of course, overseas. For most countries, this won't happen, and you'll do well by smartly allocating your cash and assets to recession-proof strategies. But what about if you followed the crowd and you threw everything that you have into the safe dollar? Personally, I don't like the idea of blindly jumping into a bubble. If you look at the currency like any other financial asset, its value has risen astronomically over the past few years. Sure, of course, it could keep rising, but do you really want to take the risk of essentially buying the top again like you always do? On the other hand, other currencies could simply keep dropping, just like how the UK seems hell-bent on crashing its own bond market. And this pushes the dollar up as more people flee financial chaos. Whatever it is that you choose, make sure that you do your due diligence and get as much knowledge about the situation as possible. Hopefully this video has been helpful in some way, and if you want to learn more about making money during the recession, please check out this video next. And as always, if you made it all the way to the end of this video, please comment in the comment section down below. Nowhere is safe. I shall see you in the next video. Cheers.